what is the biggest risk to your portfolio in 2020? Is it an impending stock market crash, or maybe the US presidential election? Both could have an impact to your portfolio, but in my view, neither will be the biggest risk to your portfolio. In my experience, time and time again, the biggest risk to my portfolio is me. For many, this may be hard to hear, as it's easier to blame someone or something else. But the fact is that it's much more likely that it's a lack of knowledge or an emotional response to stress, which will cause you to lose money in the market. So if this is the case, how can you remedy it? Well, I believe success as an investor in any market is predicated on how effectively and how efficiently one manages oneself. I think it comes down to three main points. First and foremost, I think you need to have a good understanding of yourself. Following this, you need to play to your strengths and focus your attention. And lastly, be disciplined in your chosen approach. So let's go through each point in a little more detail. Understanding yourself. In my experience, understanding yourself isn't exactly straightforward, and nor does it happen overnight. The reality is we're all stricken with bias, and therefore can't or don't want to see ourselves for the way that we truly are. I believe you need a way of objectively analyzing yourself, and of course, someone you can trust and rely on to give you an objective view. So for me, one approach to self-examination that has worked is to keep an investing journal. In the journal, I keep track of my buys and sells, tracking the standard quantitative data. Plus, I write down any emotions I'm feeling at the time of the trade. Additionally, I write out observations on the management teams and try to take a stab at who I think those people are. The key to this journal is to review it in the future and see if you're correct in your thesis and your observations. The insights gained through this, I believe, should shed some light on your strengths and weaknesses in terms of how you formed your investment thesis and your ability to judge people. And these two aspects just so happen to be two of the most important aspects, I believe, for a junior resource sector investor. For me, one of the things that I've learned over the last couple of years is that I'm a very good judge of character and people, and I should be putting more money into the people that I trust and that I believe are competent. The fact is, the 80-20 rule can be found everywhere, and is especially prevalent in the junior resource sector, where 80% of the gains are provided by 20% of the people. Additionally, I think it's advantageous to answer the following questions. How do I learn? Is it by reading or maybe by writing? But for some, maybe it's even verbal, the act of telling somebody else. For me, I learned through the writing process. My investment thesis is never clear until after I write it out in article form. Additionally, how does stress affect me? Do I become emotional? Am I able to make a decision, or do I freeze? Do I suffer a fear of missing out, FOMO? There's no wrong answer to these questions. The whole point is to know the answer. And knowing will allow you to form a plan on how to manage your weaknesses and maximize your strengths. Play to your strengths. All too often, people focus on improving weaknesses when it would be much more effective in your time, at least in the short term, to exploit and improve your strengths. Double, triple down on what you already do best. Now, it's still important to know, and most importantly, manage your weaknesses. I'm just saying not to focus on improving them just yet, and that you'll have to trust me on. Second, play to your strengths is to focus your attention, meaning use your strength to find the right investment. And when you find it, focus on it both analytically and financially. Make it a large enough investment to make it worth your time and effort you put into identifying it. So what does playing to your strengths look like in the junior resource sector? It's a great question. Maybe your strength is in identifying a company in a certain segment of the market. Maybe an explorer, a developer, or prospect generator, or even a producer. There's a sliding scale of knowledge and risk that's prevalent in each segment of the market. Arguably, the most important skill in analyzing a producing company might be accounting. Whereas at the other end of the scale, for an explorer, you got to be more focused on the geology. And reading a balance sheet does mean something, but it's nothing compared to the geological side. For example, I have a friend who won't invest in a junior company unless it has a 43-101 resource. He says grassroots exploration is too complex to quantify a value of, and therefore he plays to his strength and only invests in companies that he can analyze. And a friend and mentor has reminded me multiple times, and this is a great tip: don't invest in things that you don't understand. If you don't understand or are unable to calculate the value of a proposition of a company, then simply pass. There'll be more opportunities coming. Discipline. And I'll start this off with what I think is a great quote. Deliberate planned speculation is, in my opinion, the best and safest method to improve one's chances of preserving the purchasing power of capital and maintaining its constant convertibility into cash without loss. And this comes from the book, The Battle for Investment Survival. And it was written by G.M. Loeb. And it's a book that I try to read at least once a year. And I suggest everybody do the same. So discipline. Discipline is arguably the hardest of the three main points. Human nature suggests that we typically prefer to follow the path of least resistance, which unfortunately means no discipline. Following the path of least resistance can be deadly when applied to investing, especially in a segment of the market like the junior resource sector. There's no getting around the discipline that you must have in managing yourself. Stick to your plan or your set of rules you make, as you want to ensure that your persona is as close to unemotional and logically driven as possible. And I have a couple suggestions on the topic of discipline. First, I found that discipline breeds discipline, and therefore start small. Maybe it starts by simply creating a daily routine in your life. Bringing order to your daily life, I believe, will make it easier to bring discipline into your investing world, and that you'll have to trust me on. Second, I suggest creating a set of 10 to 15 rules that will tilt the odds of success in your favor, and that you can look back on before you make any decisions. And I've put together a few examples that may or may not be applicable to you. Rule number 1, wait one trading day before buying or selling a stock. And the idea with this rule is to minimize the effect of FOMO, or any emotion which may be surrounding a trade, like the buying or selling of the stock. This may not be pertinent for some, but others it'll be integral to your success. Sell half on a double. First and foremost, by selling half on a double, it allows you to eliminate all risk associated with your original investment. For the vast majority of investors, this is going to be a rule that has to be instituted. In fact, in some ways, I believe that you may even want to go further and say, look, 100% return on an investment is really good, and that's enough for me. Greed can be a dangerous component to the resource sector. Buy value. This may seem like a simple statement, but it will be the hardest of the rules to follow depending on how stringent you want to be. In my experience, it's been the most important rule guiding my speculations. As Rick Rule says, money is made on the delta between price and value. And what better value can you receive than buying something that is detested by the majority? Be a contrarian, or you will eventually be a victim. Number 4, be skeptical. Challenge and make sure you understand what you're reading and hearing about the market and companies. And this is a great quote from T.H. Mitchell, and he's the author of Canadian Mining Speculation, and it's another book you should add to your list as must-reads. The speculator must take the attitude that all price movements are manipulations by the professional operators. This is not true, but to be on the safe side, the speculator must operate as if it were. All news releases are promotion, all price changes are manipulations, and all important discoveries are basically unimportant. Opposite of the optimistic public, can they expect to be a successful speculator over the long pull? Number 5, the smaller the better. You don't hear that very often, but my point is to keep your speculative portfolio to a manageable size so that you can understand the companies to the best of your ability and follow news as it happens. Each person is different in how much information they can handle, given everything else that's going on in their life. In general, for people with full-time jobs but still want to speculate, having a portfolio under 10 makes a lot of sense to me. Number 6, don't speculate with the mortgage payment. Not all your speculations are going to work out, and therefore don't speculate with money that you don't have or you need to pay your mortgage or your bills. In a bull market, it can be very easy to let emotion take over and tempt you to risk it all. Speculate within the confines of these set rules, and there's less chance of that happening. Number 7, don't be afraid to sell. Without a doubt, you're going to have positions with negative returns in your portfolio. First and foremost, you want to understand why the share price is falling. And secondly, after understanding why, buy more or sell. Every day you don't sell a stock, you buy it. The tendency can be to hold on to a position in hopes that you get back the money you initially invested. But in very few cases can the companies actually put the pieces back together to be a success story. And secondly, make it your goal to find that fatal flaw in the company and get out as soon as you identify it. Number 8, read or listen to both the positive and the negative. Confirmation bias is a real part of human nature. For those that haven't heard of this, it is the act of seeking out information that confirms assumptions or theories. In the junior resource sector, this can be a huge mistake because nobody has all the answers. Actively pursue non-confirming information. Be critical of yourself. Determine how you could be wrong and the opposite opinion could be right. It can be very humbling, but important process. Finally, managing yourself isn't an easy task. In fact, I would mentally prepare for this to be a long-term project. But by starting the process now, you're way ahead of the crowd, and I believe you're giving yourself a much better chance to succeed in the market. Remember to always take the path less traveled. In the junior resource sector, I think these will be words to live by. So now for some companies. In my opinion, O3 Mining continues to present one of the best value propositions in the junior market. Since its RTO in mid-2019, up to the end of the year, O3 has been trading at half of its intrinsic value, giving the investor plenty of downside risk. The downside protection is a major part of the investment theme, but it's not everything. For those that aren't aware, O3 is the third iteration of the Osisko mining group. Osisko has a tremendous reputation in the industry, as they've been successful at the peak of the market, putting Canadian Malartic into production in 2011, and that's the largest gold mine in Canada. Finally, over the preceding 4 years, in what is arguably the worst bear market we've seen in the resource sector, they raised over $400 million, and that was to be put into their soon-to-be feasibility level study project, or Windfall project. O3 is led directly by its CEO, Jose Vizquera. Vizquera is a geologist by trade and comes from a long line of miners. His grandfather was the founder of Biona Venture, a major mining company in Peru that's listed on the New York Stock Exchange. While he's arguably the least known of the Osisko leadership group, I think that'll soon change, as in my opinion, it's obvious to me that Vizquera has the right pedigree to be successful as CEO. The next major point in the investment thesis is their dominant land position in the Val-d'Or region of the Abitibi Greenstone Belt. And I think this image from their latest corporate presentation is a great visual of the highly prospective land position that they hold, and they're actively exploring in their 50,000 meter drill program. With roughly $30 million in cash, the company has a lot of flexibility in pursuing new avenues to add value to shareholders, and I think 2020 is going to be a great year for O3, and they're at booth 425. Next is Shear Gold, and they were formerly Helio Resources. They're led by CEO Richard Williams. Williams is a geologist by trade and has over 20 years experience in the mineral exploration around the world. In 2017, Helio lost their S&P gold project in Tanzania because of a change to the Mining Act, whereby the retention license which they held S&P was abolished. S&P has a combined 43-101 indicated and inferred resource of around 600,000 ounces, and that's at roughly 2 grams per ton, 2.5 grams per ton. The recent success of Barrick settling a long-running tax dispute in Tanzania gives me, or I'm reasonably optimistic that Shear will be successful in their attempt to get S&P back. Additionally, they acquired 2 projects, the Gaban and Tinka IOCG from Palomino Gold, and I think they've got some reasonable targets on those projects. With their market cap of around $5 million, it's probably fair value for them, given their cash and the value of their projects. But I think the real upside potential could be if they get S&P back, in which I think if they do get it back, they'll sell it and they'll have a good cash position to further explore. And they're on booth 411. Last but not least, Abracada. Last year, Abracada merged with Aethon Minerals to form the new company that we see today. The deal was finalized at the end of the year. Abracada is led by CEO John Miniotis. Miniotis has over 14 years experience in the business, having held leadership positions with Orico Metals, Leni Mining, and Barrick Gold. Abracada's main focus is their flagship Dilobos project, which is located in the Salta province of Argentina. While Argentina presents its own political risk, Salta has proven to be a stable region of the country for miners, and especially given Abracada's current market cap, to me the price to value ratio and to risk is there. A few highlights: the after-tax NPV of Dilobos is over 200 million US, an IRR over 30%, and they have over 140 million ounces of silver equivalent ounces, which if you're familiar with the silver space in particular, even having over 50 million ounces is something that's fairly rare. So they're in a very good position. Finally, from the Atheon portion of the merger, they've got a collection of JV-ready Chilean projects, one which was JV'd with Rio Tinto last year, where Rio Tinto can acquire a 75% stake for a $25 million spend, and I believe that's over 5 years. And here's a few more picks, and I'll just highlight most recently, last week I was buying Altius Minerals. There's a number of reasons why I did that, but I would keep them on your watch list for sure. And then finally, right now you can subscribe to my newsletter. I write free research, but I am announcing that I am starting Junior Stock Review Premium, and it'll be offered, the first issue will be in February. So if you're interested, I highly encourage you to become a free subscriber now, and you will get a discount when that gets unveiled in February. Thank you very much for having me.